Three common reasons that traders fail while using moving averages is one, because they're saying, okay, price is above a moving average, so that means that we're in an uptrend. Not true. They're saying, okay, when price touches a moving average, that means I need to buy or sell. Also not true. Or my favorite, okay, since I just saw the cross of two different moving averages, that means I should buy or sell. All three of those do not work. But what I want to do in this video is show you three different tactics that helped take moving average trading from something that was not profitable for me at all to something that now is an extremely lucrative part of my own trading plan. Without the three tactics I'm going to be showing you in this video, moving average trading would not even be a part of my arsenal. But with these three tactics, moving average trading is something I use often to pull profits out of the market. So if that sounds good, go ahead and click that like button for me. Go ahead and subscribe if you are new, and I'll see you on the other side of the intro and disclaimer. Welcome back, and let's go ahead and get started. First off, using moving averages to define trend. A moving average by itself is not going to define the trend of a market for you. As with all indicators, price is king. Every indicator is based on price. So what I mean by that is it's important to combine market structure with a moving average. So tactic number one is to combine market structure with a moving average when trying to identify trend. Let me do an example of what I mean up here on the whiteboard to make it really simple. So we're going to use blue as our moving average, and we're going to use a black line as price itself. You've probably noticed this before, but there's a lot of times that price will be doing this here between a moving average before finally starting to head higher. So I just accidentally erased all my lines, but I got them drawn back now. So instead of just looking at price and going, okay, we're above the moving average, that means we're in an uptrend, or we're below the moving average, that means we're in a downtrend, we're going to add market structure to this. We're going to wait on price to be making higher highs and higher lows while pushing above that moving average before we classify something as being in trend. And the reason we're doing this is because if not, we're going to be caught up in a lot of consolidation. And if you're trading a trend continuation strategy, then your job is to stay out of consolidating markets to avoid losing more than you should be losing. So with that being the case, what we're going to look for is something I call a 1, 2, 3 move. It's very simple. We're waiting for a push up. We then want to see a high made. We want to see a higher low. Here's the higher low from our previous low. And then we want to see a higher high. At that point is when we can define something as being in an uptrend. So using this tactic, we're using our moving average as more like a guide than as a definite, if we're above it, we're in an uptrend. If we're below it, we're in a downtrend. Instead, the moving average is going to be a guide to let us know which direction we should be trading, but our overall interpretation of the trend of a market is going to be based on price itself, making higher highs and higher lows. Doing this will keep you out of consolidating markets a lot more often than just looking at a moving average for trend identification. And in case you're wondering, my favorite moving average to use for trend is the 50 EMA. There's some people that look at trends as more of a long-term spectrum. They may choose to use the 200. There's people that look at more of a short-term spectrum. They may choose to use the 20. But my favorite, and the one we'll be using today for trend identification, is the 50 EMA. Now that you have a grasp on this on the whiteboard, let's go down to some real charts and take a look at what it looks like on real charts. Here we are on some real charts, and I want you to look at this chart and decide, when do we go into trend? As you can see, we have a period of consolidation here. Where would you say the market begins to trend in a specific direction? All right, hopefully you have that in mind right now. Let's go ahead now and actually take a look. Let's draw it out together. So what happened here is price pushed below the 50 EMA. At this point, what are we looking for? We're going to be looking for a 1, 2, 3 move. Remember, 1, 2, 3, or in the upwards direction, it would look like that. It would be to the upside, obviously. So we're going to be looking for that 1, 2, 3 move as price is consolidating to tell us we're done consolidating. What do we get though? We end up getting this consolidation period that does not come with a higher high and higher low until right here. Now this is barely a close below this previous low, so I would not quite count that as markets being in a downtrend. I want to see a significant break of this previous low. We do not get that here. So then we go down to a low, we go up to a higher high, we go down to a equal low, we go up to a lower high, but we don't get a significant close below this low. So what this means is that until this moment, we push up to a high, we have our low, we push down to a higher low, and up to a higher high. This is the moment, once we close above this high and get a higher high, that we say this specific pair is now in an uptrend. And everything before that was just consolidation. Imagine trying to trade a trend continuation strategy during this period of consolidation. You would have come away with a ton of losses. So instead, waiting for trend based on price is going to give you a much more accurate indication of the trend of a market in your trend identification. Let's take a look at an example of this in the bearish direction now. Here's a bearish example on the euro pound in real time. As you can see, we touch our 50 EMA here. We then start a period of consolidation as we're retesting these highs, pushing down, going back below the 50 EMA, back above it, back below it, back above it. And at what point are we actually in a downtrend? Well, it just happened. We have price now pushing down below our 50 EMA, followed by, what would we call this? This would be our lower high. So for a downtrend example, we're looking for a high, followed by a lower high, and we're also looking for a low followed by a lower low. So since we do in fact have that lower low, in this case, this has just been identified as being in a downtrend. We're using the 50 EMA as our guide, and price is showing us that we're now in a downtrend. So what we expect when we see something like this out of price is that price will continue and push down, eventually making equal or lower lows before breaking above our previous swing high. So with that being the case, that's what I'm expecting to happen here on the euro pound. We could have more of a pullback for sure, or we could go ahead and push down now. We don't know. But what we do know is that the likelihood of this pair continuing lower at some point before going above our high is higher than the likelihood of us pushing up and reversing here, because the price itself is showing us that we're currently in a downtrend here on the euro pound. As an added bonus, if that seemed a bit too complicated, something else that I use from time to time is if I see price touch the 50 EMA, I will place a horizontal line at the swing low along with at the previous highest swing high before the touch of the 50 EMA. And at this point, I'm seeing everything in between these two levels as being a period of consolidation until price breaks out of one of these two levels, as in until price either breaks below that low, or if we see a reversal and price comes up and breaks above that high, I'll see this as an uptrend and see this as confirming a downtrend. So in this case, let's see what price does. As you can see, we're just kind of pushing around through here. And another note here is that if I see a wick go through this level, I always go with the lowest wick. So at this point, I would then move this down to the lowest wick. And now everything between here and here is just a period of consolidation for me until one of these levels is broken out of. Clicking play again, you'll see that eventually we do in fact break out of this to the downside. That would confirm a downtrend for me. So this is another way you can use if the way I showed earlier was a bit too complicated. And as you can see, it gives you a bit of an earlier signal as to the identification of a trend, but it'll be a little less accurate than the previous way I showed you. I did want to give you that as an option though, as I see this as being a much more simple way of identifying trend after a period of consolidation using the combination of a moving average and price. The second tactic I'm going to be sharing with you has to do with using a moving average as an area of value. Now, as I stated in the intro, you don't want to just buy because price is against a moving average. That's not going to be profitable at all. But one thing that we can use to help the probability of success and to help make profits using moving averages is something I've never heard talked about here on YouTube. And that is using the moving average that works best with that specific currency pair. Now, if you're brand new, that may have sounded a bit confusing, but it's very simple. Certain currency pairs work best when bouncing off of certain moving averages. And I'm going to keep it really simple. There's only 3 that I use for areas of value. And by the way, when I say areas of value, I'm talking about buying or selling with the bounce off of a moving average. The only 3 that I use are the 50 EMA, the 20 EMA, and the 100 EMA for this specific type of strategy, using the moving average as like support and resistance. And to give you an example of this, I'll give you 3 examples actually. Throughout all of my testing, pound pairs, GBP pairs, work best when pushing off of the 20 EMA. To give you an example of that, take a look at the chart. Right now we're looking at the pound dollar, and as you can see, yeah, we use the 50 EMA as support and resistance a few times here. Resistance, support, maybe you could, yeah, right here you could call that resistance as well. Right here you could call that resistance. Now let me switch this moving average from the 50 EMA to the 20 EMA. Do you notice a difference? As you can see, pound pairs tend to respect the 20 EMA much more than other pairs. Other pairs may not respect the 20 EMA nearly as much as this, whereas pound pairs do tend to do so. And the only way that I found that out, and the only way you'll be able to find out which currency pairs work best with which moving averages, is to actually test it yourself. You'll have to go through historic data and test the amount of times you had successful bounces off of a specific moving average. And also, as an added bonus, you don't want to just buy coming off the moving average. You want to make sure you have some type of confirmation, whether that be a green candle for a buy, a candlestick pattern. You go to lower time frames and look for chart patterns. Those are three of my favorite ways to use a moving average for an entry, combined with a few other things. But those are the types of things you would like to look for when bouncing off these moving averages. But the second tactic is to use the moving average that best coincides with the currency pair you're trading. Again, to save you some time, the pound pairs work best with the 20 EMA. From what I've tested, at least. Feel free to test other moving averages. Feel free to test other pairs. That's completely fine. Yen pairs, meaning the dollar yen, the Aussie yen, the euro yen. These pairs tend to work much better with the 50 EMA than they do with the 20 EMA. What I mean by that is they tend to use the 50 EMA as support and resistance more often than other pairs. These are the pairs with yen in them, okay? And next up, the 100 period moving average is something I like to use for the euro dollar. This is one of my favorite pairs to use the 100 EMA with, because it tends to respect the 100 EMA as support and resistance a little more often than other pairs. Now, this on its own is not going to give you some massive edge, but it's going to help you create an edge by using the correct moving average for specific currency pairs based on what moving average works best for that specific currency pair. And again, just to save you some time, 20 EMA works best on pound pairs. Yen pairs work well with the 50 EMA, and the euro dollar tends to work well with the 100 EMA. And now that I'm looking at this chart, this trade should have been stopped out for break even. Trading mistake. I make them too. And because of it, I've now just lost $500. Fantastic, right? Happy Thanksgiving, everybody. Let's go ahead now and take a look at the third tactic, and I'll see you there. The third and final tactic I'm going to be teaching you today is by far my favorite trade setup, using moving averages. It also deals with using a moving average as an area value to buy or sell off of. And as you can see, this is actually a trade I am currently in. And on top of that, it is a trade that we sent out to the TTC Forex University members. I'll put a screenshot of that email to the left side or right side of your screen. But if you want to get involved in our money back guarantee Black Friday deal, which means that we have a money back guarantee that has no time limit and is no questions asked. You literally have a complete money back guarantee. Try it out. If you don't like it, send us an email. We'll refund your money. That's the deal we're doing for Black Friday on the TTC Forex University. If you want to learn all the details about that university, all you got to do is click the top link in the description or go to www.ttcfxuniversity.com to check that out. Otherwise, let's go ahead and continue here with my absolute favorite setup, using moving averages. And if you haven't guessed already, based on being a part of the channel for a while, if you're brand new, you wouldn't know this, but if you're someone who's been around for a while, you know how much I like horizontal levels of support and resistance. So the third and final tactic that I'm going to share with you is what I used to get involved in this trade, which is waiting for a moving average touch to also align with a previous level of support and resistance that's been tested and used as support and resistance multiple times on a specific currency pair and for a specific trade. So in this case, we had price pushing up, making new highs above our 50 EMA. We then had a pullback all the way down to the 50 EMA, which can already act as an area of value. And on top of all of that, we have price coming back into the previous level of support that's been previous level of resistance and support that's been tested multiple times, as you just saw looking left. When you combine all of that together, it equals some of the most profitable and most likely opportunities to trade based on bounces off of moving averages when you combine it with an area of structure. And the reason is there's already traders looking at this area for potential trades that don't even use moving averages. But when you combine that moving average, because there's also traders that are looking to trade the bounce off the moving average that don't really pay attention to structure. So when you combine all of this buying pressure and you wait for a confirmation, like buying pressure with this big green candle, then that can give you a really accurate trading opportunity. And that's exactly how we got involved here on this Euro Canada trade. Again, waited for price to be trending above the 50 EMA, then waiting for price to pull back to the 50 EMA and waiting to make sure the 50 EMA aligns with the previous level of structure is the most accurate way that I have of trading based off bounces off of specific moving averages. So hopefully you can see how combining all three of these can equal really accurate trading opportunities. What I want to do is actually show you a bearish example of this to make sure you have a full grasp on the third tactic, which is combining major levels of structure with our moving average trades. So let's take a look at a bearish example of that right now. Here we are on the pound dollar. And if you'll remember on the pound dollar, what is the best moving average for this pair that I've found, at least in my testing? That would be the 20 EMA. Our red line on the screen is in fact the 20 EMA. Now, what are we looking for when trying to combine structure with a moving average? Pretty self-explanatory, right? We want to see a level of structure looking left that's been tested multiple times. Do we have that? Yes. Where price is right now is a previous level of structure that was tested and used by this market multiple times in the past. So with that being the case, we have a zone of structure we can look at. And what do we want to combine that with? We want to combine that with a touch of our moving average. Let me go ahead and thicken this up a bit to make it easier for you guys to see. That red line, again, is the 20 EMA. So we have our moving average here. We have our area of value being our level of support that's been tested multiple times that could, in fact, turn into resistance and push this market down. And if we hit play here, what do we get? We get the touch of the EMA. So that shows that the EMA is acting as resistance along with a shooting star candle. So this would be a good example of somewhere that I would place a trade based on all of my factors coming together. I have trend happening below our 20 EMA. We have our 1, 2, 3 move, right? Push down, that's 1, that's 2, that's 3. We have a lower low, we have a high that's lower than our previous high. So we're in trend to the downside. We then have price pulling back up to an area of value being this previous level of support that's likely to act as resistance in combination with the 20 EMA, which happens to be the best moving average for the pound dollar. And on top of all of that, we get this shooting star candle. This would be the area I would place the possible trade. And I would probably look for something like a 1.4 to 1 reward to risk ratio because that's my favorite way to take targets. As you can see, price did in fact push down from that level. Now, of course, every trade using any of these methods does not work out. I realized while editing that what I just said made it sound like these trades never work out. But what I meant to say is that they won't work out every single time. It's important to prepare for losses. Let's go ahead and continue. And that's why it's so important to understand the foundation of trading success. A successful trading career is built kind of like a pyramid. Let me draw you an example of that. So what I mean by that is the base of your pyramid needs to have a solid foundation. And the base of our pyramid, our trading success pyramid, is going to deal with two very important things. Trading psychology, which is the emotional state and just in general, your ability to handle your emotions while you're trading. A lot of people get greedy. They overtrade because they just want to make money quickly. That greed is an emotion we have to be able to control as traders. A lot of people are extremely fearful after a couple of losses in a row, so they decide not to place that next trade, which could have been a big winner. That fear is something we have to be able to control, and that's what creates a solid foundation for trading success. And trading psychology is our ability to be able to do that. Another part of the foundation of trading success is going to be your ability to have a good risk management plan that helps you handle those emotions and keeps you from blowing your account and losing more than you want to on a specific trade or on a combination of losses, which will occur throughout your trading career. So this foundation of a good risk management plan and good trading psychology is absolutely necessary for anyone to become a successful trader. And it's what you're going to need when you go through inevitable periods of drawdown and losing streaks, which will happen. I know this video was filled with a lot of trades that won. That's just because it's the best way for me to give you examples. Again, you will have losing trades even as a professional trader. I have losing trades. But the tippity top, oh my God, can't believe I just said that. The top of this pyramid, that was a rough one, is going to be what we just discussed. Some type of trading philosophy. We call this a strategy in the trading game. So it's going to be your strategy or your system that you actually use to gain an edge over the market. That could be things like combining structure with a moving average as an area of value, waiting on a candlestick pattern, and using the proper EMA for a specific currency pair. That combination of conditions and entries would be the makings of a strategy we use to pull profits out of the market that gives us our edge. And whenever you combine a good trading foundation with a good strategy, you end up a professional trader. That's what creates a successful trading career. So with that nugget of knowledge, I hope you guys enjoyed this video, and ladies, I hope y'all enjoyed the video. If you did, make sure to click that like button. Make sure to go ahead and click that subscribe button if you are new. Again, we're running a money back guarantee for Black Friday, where essentially you can try out the TTC Forex University. If you love it, awesome. I expect you will. But if you don't, I am a bit biased. If you don't love it, all you have to do is email us, email my support staff, and we will get you refunded ASAP. It is literally a money back guarantee offer. So if you're interested in learning the details about the TTC Forex University, all you gotta do is click the top link in the description or go to www.ttcfxuniversity.com. I hope you guys have a great Thanksgiving. I hope you have a great weekend, and I'll talk to you in the next video. See you soon.